Hello, and welcome to this episode of To the Point. I'm Neil Stanley. Today we're going to talk about the expected path forward and how deposits are truly in the crosshairs in this time. Interest rates have risen dramatically in the first part of this year, as we can note that the 2-year has gone from 0.78 beginning of the year to 2.70. That's 192 basis point, and a huge increase as a percentage from where we were at the beginning of the year. Here's a graphical representation of the U.S. Treasuries. We know that the Fed is in control of the Fed funds rate. Currently that rate is 0.5%. But the Fed has a dual mandate. They're responsible for two things: keeping the employment full and keeping pricing stable. They focused in on bringing down unemployment, but inflation has taken off since the middle of 2021. This graphical representation shows GDP in blue, the level of unemployment in red, inflation in purple, and interest rates in green. And we can see that in 2021, the level of inflation became quite significant and is today over 8%. With Fed funds still at 0.5% as we enter the month of May 2022, and the industry has low loan-to-deposit ratios, it's easy to believe that all financial institutions should just sit out the rate increase. But some offerings are showing that they are keeping up with the Treasury market and the potential Fed funds market. So look here at Edward Jones, where across the country there are thousands of offices issuing these rates for time deposit holders. Long-term savers today could get 2.7% on a 2-year. That is a very relevant factor when it comes to financial institutions' need to price and manage the attraction and retention of deposits, because they're not rational with treasuries at 2.7, and that's where their rate is. So how do we look at this? It's not just Edward Jones. Over 1,100 financial institutions, according to our research, have a 1% or higher CD APY offering for depositors today. So with the path forward of overnight Fed funds, it becomes hugely important what that path looks like. When we look at the CME FedWatch tool, which is looking at the Fed funds futures market and where investors are believing that the Fed funds will land at each meeting, we can see the meeting dates and the probability of different rates. So there's a very high probability that we will get a 50 basis point increase in the May meeting, taking us from 0.5 to 1%. Very importantly, though, in the June meeting, it appears that the Fed funds futures market believe that we will get a 175. Now, we know that these are not, these predictions can be wrong. These rates move. If you would have looked at this some time ago, this would be dramatically different. So this is not destiny, but it is real people with real money placing investment on these projections. And it also is highly dependent upon the dot plot that was issued by the Federal Reserve as well. So as we look at this, we're seeing a 1% in May, a 1.75% in June, up to 225 at the next meeting, 250, 275, and ending the year at 3% with a fairly high degree of probability. So what should banks do? We should be, and we will be, slow to reprice overnight interest-bearing deposits. The median cost of those deposits at the end of the year, 0.12 for transaction accounts, 0.17 for other savings accounts. To cannibalize or reprice those would be a very, very powerful negative in the performance of financial institutions. Why do I say that? Because the concentration in non-interest-bearing, in interest-bearing deposits with non-maturing structures is 63% of deposits are in interest-bearing deposits. 30% are in non-interest-bearing deposits, and only 7% are in time deposits as of the end of 2021. Well, what that does for us is, as an industry, we need to look at the dynamics of attracting new money, moving money from one financial institution to the other. It won't happen with just a few basis points. It's going to take something significant to reallocate, to move retail depositors from one place to the other. So time deposits and broker deposits will offer the lowest marginal cost, because setting a rate on a savings account that's going to move money to you would be far too expensive as you reprice this big bulk of your accounts. And we know that broker deposits, although they have a low marginal cost, create no relationships and no franchise value for the institution. So what happened the last time deposits became competitive? We saw that time deposits were the fastest growing element in the industry. And we believe that's going to occur again. How will we evolve? What will it look like? This is actual deposit pricing in March of 2022. The green line is the Federal Home Loan Bank advance rate. The brownish red line is the U.S. Treasury rates as of March. The large dark circles would be an offering of a typical financial institution, standard offering, and all of the other marks would be their competitors. Notice here that there is a very systematic approach to having a pre-authorized negotiated price point so that they don't lose the deposits to a competitor who might be trying to win over cheap deposits that are still priced above our standard rates. And then we have also what we call hybrid or qualifying savings. These are not just any ordinary savings. The depositor has to qualify by either opening up a new certificate or by having a maturing certificate with our financial institution. So as we move from March of this year into April, what we saw is many financial institutions who stayed steady during that time of interest rate movement that was quite significant for U.S. Treasuries and FHLB advance rates. So that was actually April numbers. And so when we look at the FedWatch tool, let's consider a couple data points, a couple potential time horizon terms. Let's look at June, where we are expecting a 175, and December, where we're expecting a 3% rate. So if we go forward and we don't move any of our retail deposit rates with either standard certificates, customized certificates, or savings products, and U.S. Treasuries move in order to accommodate a 175 Fed funds rate, you're going to see this big gap between local pricing and wholesale pricing. How's that going to be addressed? What will depositors be ready to do? What will financial institutions do? What will you do in this environment? And probably as important, although June is just around the corner, December's not that far away. And if December Fed funds are 3%, what kind of pressure are you going to have? Now, if no competitor moves, it'll be a wonderful world. You'll just keep your rates right where they are for those standard rates. But if you don't have these other tools with the qualifying savings and the customized certificates, that pre-authorized negotiated price, what will you do? How will you get all the deposit volumes you need as your competitors venture into this new territory below U.S. Treasuries, but still far above where they are today? What is your team doing right now to prepare for this event? We're so pleased that our Core CD clients have the tools to be ready for this environment. Please contact me if you would like to meet to discuss your current preparations for this environment. I love it when I work with all of our clients, and I love to hear from prospects as you set up meetings with me after these sessions. I want to thank you for taking your time to watch this episode of To The Point.